Stocks stay bid up following a tech rally in the US overnight. Realty and IT are the prominent gainers, even as FMCG and utilities drag. Midcaps fare better.
IRDAI has sharply hiked the sum a policyholder of non-linked, non-participating policy will receive on surrender after a year. The move is likely to impact the profitability of life insurers and also possible incomes of distributor agents.
L&T Finance jumps after prominent private investors exit via block deal. Sobha climbs on its rights offer at a steep discount, while Nestle bucks the FMCG weakness on keeping royalty rates unchanged.
US Federal Reserve kept policy rates unchanged and indicated only one rate cut this year, but the committee noting progress towards the 2% inflation objective was a real positive signal.
Hello and welcome to Halftime Report. I'm Ekta Batra and with me is Manglam Malu. Well, it is turning out to be a session where the broader markets continue to outperform. So we have the Midcap index, which is up around 0.6%, a good advance decline ratio on our hands as well. I just want to point out that now on a week-to-date basis, the Midcap index is up around 2.5%. The BSE Small Cap index is up around 3.6% as well. Today, there are around 244 stocks as per the Bombay Stock Exchange, which are at fresh 52-week highs, and only 12 stocks which are at fresh 52-week lows. Also, a lot of stocks with a lot of interest, which we can see on the screen within the broader market. So, fresh 52-week highs for the likes of Exide, Nesco, Home First Finance, just to name a few. Lively market, Manglam, on our hands.
Lively indeed, and what's interesting is that today the sell-off from the highs happened in the earlier part of the day, and from the lows we've actually seen a recovery. So we're back closer to the 23,400 mark for the Nifty and the 50,000 mark for the Nifty Bank as well. So as you can see, there was a mild dip, and from there has been a recovery from the low. So currently we're going back towards the higher end of today's trading range. The Nifty Bank briefly dipped into the red as well, and that has been bought into. What are the stocks which are doing well? We have from the frontline end HDFC Life, which continues to do well. Maybe the street is now looking beyond this uncertainty and looking at the surrender value as maybe buy on news and sell on rumor earlier. We're seeing decent traction on names like Shriram Finance as well, which has moved to the high point of trade. Titan as well, as we speak, is doing well. And then we have a bunch of other IT stocks. Midcap IT in particular is doing a lot better because yesterday, going into the event, the Fed event, the IT stocks had sold off. The IT index ended at the low point of trade. So maybe some bit of a pop happening out there. Look at names like Oracle. The global parent has gone ahead and signed a deal for artificial intelligence. That stock doing extremely well. Not sure if there is a financial angle here between Oracle and the parent apart from the ownership. But, there is sentiment up move which is taking place.
Yes, absolutely. But the other stock that we're going to kick off the show with is Nestle, which is in focus today. The board has approved to keep the royalty license fee unchanged at 4.5%. Manglam, explain how relevant this is for Nestle India.
Well, for Nestle, this was a foregone conclusion, largely because the royalty that they would pay earlier was 4.5%. It was very recently where the shareholders had rejected the proposal of the company, increasing the royalty rate from 4.5% to 5.25% over a course of 5 years. And as a result of which the board has gone back and said that now they'll pay only 4.5%, and which is what it was earlier as well. So no change out there, a sentiment positive, an overhang gone away, and which explains the stock being in the green. But what explains that even more is CLSA has written a note this morning saying that F&B is actually the best way to play the rural boost to consumption. They've gone ahead and upgraded Nestle to outperform, target raised to just under 2,800 rupees. They've done some analysis, periods of FY5 to FY8 or FY16 to FY18, where they've said that this was the time when Manrega spends were increased. And during these periods, Nestle and Britannia actually saw their business grow higher than median, and the higher competitive intensity in home and personal care makes it a lot less attractive as against F&B. So if there is a rural push, then it's best played via F&B stocks. But speaking about consumer itself, let's put focus on the FMCG sector. ICICI Securities expects higher spending on welfare schemes, and these welfare schemes would likely drive faster private consumption. they also expect sustainability of recovery in rural demand as the tailwind for FY25. So to discuss this and more with us, we have back in our studio Manoj Menon, who is the Head of Research and FMCG expert at ICICI Securities. Manoj, thank you. Always a pleasure having you with us in the studio.
Thank you, Mangla. Thank you, Ekta.
So, let's dive in immediately. Everyone is saying there will be perhaps some push coming in from the government, SOPs to boost consumption, etc. And you've also in your note written that not only is the street expecting that, but a large part of that is also priced in. Yeah. But over the last few trading sessions, people are believing that maybe policy continuity will come by. There will be more rational spends by the government to boost consumption. So, as a result of which we saw the stocks come off as well.
Right.
What are the expectations now?
Okay, let me take in two parts, as always, right? Because there's always both sides to the coin. The first part is actually that leave for a minute what happened in the last 1 month or couple of weeks, right? I mean, so if you go by the commentaries by most of the companies after the fourth quarter, company has been clearly calling out two aspects. One, the syndicated data, whether it's Nielsen, IMRB, Kantar panel, etc., is already showing some signs of rural recovery. Secondly, since companies have got visibility on outlet level revenue, they're also qualitatively committing that they're actually finding some green shoots, right? Majority of the companies, not all of it, right? So it appears that a rural recovery is absolutely on track. Okay. Now, what does it actually mean that even if valuations are punchy, let's say in line with the last 5 and 10 year average, the fact of the matter is that the expectations of an upgrades will remain for a fairly long period of time, right? Second point is that if you generally look at the ownership of FMCG stocks in particular, let's say versus discretionary, it appears it's under-owned, which essentially would mean that it will be a buy into dips sort of a situation rather than a sell into rally.
Okay. Well, just wanted your thoughts in terms of what the expectation is when it comes to the budget. And, what are you telling your clients when it comes to purchasing consumption stocks ahead of that? Do you think that it's probably going to be consumption friendly, consumption focused?
See, going by the expectations currently, it appears a fair probability that there will be a slew of announcements, etc. That said, we just don't have any concrete evidence to actually take a call this way, that way, right? I mean, just about the short term. Our take is that, if I look at FY25, let's say 12 months from today, let's say for the sector, price growth, let's say, didn't exist in FY24, right? That kind of is getting into the base. Point number 2, there are green shoots of volume recovery already happening. Point number 3, urban continues to perform well. So if I put plus valuations and expectations of upgrades, etc., essentially would mean that, the companies which in our opinion, which are doing self-help, right? What I mean is essentially that they have a strategy on their own and not just waiting for macros, which is a thesis for a fairly long period of time. They should continue to outperform because they have a strategy in place. On top of it, if there is a tailwind, it's a double engine sort of growth for them. All
right, so they're doing well, and if the environment does well, they'll only do better because they are already put in, levers for growth. So speaking about levers,
that's right.
Higher rural wage has high correlation with HUL's volume growth.
That's right.
What are you penciling in this year for HUL's volume growth? And do you think time now has come for one to look at this giant because it's underperformed for a very long time?
Good question. So we have done this analysis over the last 20 years, based on Reserve Bank data. So Reserve Bank publishes rural wage growth and rural consumer inflation, right? Now, essentially, the gap is the actual purchasing power, right? If you actually plot this versus HUL volume growth, you actually find a correlation of almost 0.8, right? It's undisputable, right? If the expectation is of a rural affluence incrementally, it's a logical assertion to actually say that whether it's HUL, whether it's Dabur, whether it is Nestle, Marico, the whole host of companies, right, will actually get a tailwind. So I'll not really single out HUL here. Companies which has got a fairly high rural exposure, in conjunction with a good performing urban portfolio also, right, are the winners here.
Dabur is not in your top picks, why?
It's actually fairly punchy in terms of valuations. There is nothing really wrong in the strategy as such.
Okay. All right. If you had one key risk that you had to point out, going into the rest of this year, what would it be for consumption stocks? Which one do you think would probably even be more vulnerable?
I think unexpected inflation, right? Typically, consumer staple companies perform well when there is a certain predictability in terms of inflation, right? So that you can actually plan your budgets appropriately, right? Let's say Ukraine war happened, right? Suddenly there was a significant inflation. Companies were forced to take price increases to somewhat protect margins. And consumer incomes are not growing in line with the inflation, right? So which in that sense, kind of down trading, etc., all those issues actually happen. So if there is an unexpected crude inflation basket sort of a scenario, I think the sector kind of would struggle.
But the probability of that happening is quite less.
That's that's a toss of a coin call, right? So you never know. We're talking about a commodity, right? I mean, so.
Just from an upside from current levels, what is it that you see on stocks and where do you see the maximum upside? Because, okay, if things improve and all of that and stuff, stocks are trading at punchy valuations as compared to their averages.
Yeah.
Where do you get that alpha? Is it likely to, just be a little over what the Nifty is doing, or how much more scope for outperformance is there?
So I'll put again consumer staples into two baskets here. Let's say companies like Marico, which are trading at acceptable valuations, where there is the D2C execution aspect, there is a distribution expansion which they're implementing. So the potential for upgrades, let's say in a company like Marico, is very high. Earnings upgrades, that's point number one. Or there are companies like Jyoti Labs, right, where the visibility of let's say distribution expansion, market share gains is very high. The valuations at around 30-32 P is absolutely acceptable, right? The second basket is company like Godrej Consumer, Tata Consumer, which we spoke last time as well, where valuations are punchy. But the predictability for the next 12-24 months is so high that you can expect earnings rollover-led stock performance.
Okay. I can't see Titan on your list. If you could just give us a sense in terms of what your approach is towards Titan.
Yeah.
And you also like Kalyan Jewelers.
The thoughts are same actually for a very long period of time. Look, we are downgraded Titan some time back, and the thought process actually has been that two aspects has happened in the market currently. One, there has been a higher acceptability of newer brands from a consumer point of view.
Yes.
Tanishq is not the only choice for the consumer at a pan-India level. Point number two, there is also availability of capital for most of the regional jewelers also. And point number three, hallmarking has essentially increased awareness from a consumer point of view, saying that I can trust multiple, otherwise you would have, let's say, not so be comfortable sort of brands as well, right? Now, Kalyan specifically is a classic case of being in the investment for a very long period of time, and they're just getting the benefits of the earlier over-indexed investments in terms of brand awareness, visibility, etc. Lastly, on Kalyan, one trivia about the Kalyan is that, I'm not sure how many consumers actually realize that it's actually a brand from Kerala, because the brand, the word Kalyan, essentially stands for goodness, etc., in almost all Indian languages, right? See, from a consumer perception point of view, if you have to walk into a jewelry store, you need to believe that it's either your regional sort of an affiliation, or you have to believe that it's a pan-India brand, right? I think the name also kind of helps. Apart from the other good execution what they've been doing.
I'm not sure that was the only reason.
Apart from multiple reasons,
because of the founder, Mr. Kalyan Rama, as well. But just to wrap this discussion up, retail. Eventually, if you're looking at consumers going ahead and increasing their purchases, they would have to purchase it via retail. So where do you stand on that? Value retail. What are your thoughts? Which ones do you like? And then quick commerce. That's suddenly blown up as a channel.
Yeah. Look, I think we do believe that there is an intersection of value and convenience, right? Now, obviously, quick commerce is performing well, but I do believe that there will be a point in time, 12-24 months hence, right? I mean, kind of quick commerce will have to find newer avenues of growth, because it's actually over-indexed on convenience and not necessarily on value. And India, relatively being a poorer country, DMart is probably the only value retailer at scale. I'm not talking about VMart, which is an apparel retailer. I'm talking about the larger, retail, right? So we continue to like DMart. I think a lot of the perceived disruption from quick commerce is already there in the price.
With the growth in Zudio and now possibly Star, would you think of Trent as a value retailer as well?
Trent, business is value. I'm not sure about the stock.
Okay. Well, before we let you go, just a question in terms of the one stock which you would recommend as a buy across the sectors within the FMCG space, and the one top sell that you probably have in this year.
Okay, so without looking at market caps, right? So we continue to back Jyoti Labs on the consumer staple side. We do find that Zydus Wellness is likely to turn around, etc. So that's another aspect which has been a forgotten stock for a fairly long period of time, right? I think they're getting the execution right, and it's been a great summer, etc. Right? So that's on the staple side. Large caps, again, it's Marico, Godrej, the boring names, Tata Consumer, etc. Right? I mean, so nothing new. Outside of that, we have a reduced rating on Asian Paints, and it's been a high conviction for a fairly long period of time. And as each day passes by, which we do believe that downsides actually is higher, and as Grasim continues to execute over the next 12 months.
What have you found out on the ground with regards to the early acceptability of Grasim's product?
It's too early. Let's say, for example, I was in Chennai last week, and I just found a lot of hoardings of Birla Opus. So I think the context to note here is that they have put up the capacity, but the front-end brand building, let's say supply has been created, but the demand side is yet to happen. But when we talk to dealers, etc., we do find that there is a reasonable amount of acceptance, in let's say nation-dominated markets, etc., of the willingness to actually try out a newer brand at a dealer level as of today.
But smaller paid companies, would you be incrementally more negative on them?
So we have a thought process that which we have been publishing over the last 6 months, saying that for any contrarian investor, right, from a game theory point of view, if you really believe, let's say you can have a point of view saying that, let's say Grasim may not succeed. We don't have that view. I'm just saying you can have that view, right? If you have that view, you're better off playing the paint sector by actually having a positive stance on the smaller names, which is Axo, Indigo, and Kansai, for a variety of reasons. Point number one, these companies, let's say Axo and Kansai Nerolac, has got a higher exposure to non-decorative, automotive and industrial, where it is business as usual, right? Second point is that, let's say an Axo Nobel is a premium company, right? It's very unlikely that a premium player, consumer stickiness is low. It will be fairly high, right? And Indigo has been executing well, actually.
So, since we have you with us and since it's time for a meal as well, what are your thoughts on F&B space and QSRs? And then there's liquor as well, where there is still some policy clarity awaited?
Yeah. I wouldn't really put Nestle. I heard you speak about it a little earlier, as an F&B play, right? Because it's just about probably...
That was CLSA's call, not
No. I'm just, sorry, it's not about that. So what I'm just saying is that, look, Nestle, probably about 1/6 of their revenues and profits come from, let's say, F&B, right? It's really not an F&B play, right? So Varun Beverages, for example, squarely is, right? I mean, so probably Varun Beverages is a better option out there. Other than that, look, QSR, we are finding at least things bottoming out, right? And lastly, on Jubilant, the strong conviction that the delivery fee waiver by Domino's, in our view, is a potential upgrade opportunity, because it's a unique situation where they are the only brand which can actually offer you delivery waiver because they have their fleet and they have their app, etc. So to that extent, they're not that reliant on the aggregators, right? It's certainly a competitive advantage, and I think it's a J-curve sort of recovery we expect in Jubilant.
We heard that from Sameer Khetarpal when we spoke with him. He said that the delivery cost waiver has actually led to good growth in not only the fourth quarter, which we know about, but first quarter as well. India-Pakistan game, he said that a lot of pizzas were sold at that time, and they've opened 2,000 stores now on the Domino's front.
That's right.
Okay,
That's right.
all right, Manoj. But on that note, it's been a pleasure as always. Thanks very much for joining in and speaking with us. I'm sure we're going to touch base with you as we move closer towards the budget and post-budget as well. Thanks very much.
Thank you.
Well, before we take a short break, let's in fact just take a quick look on the markets. The Nifty is holding with a gain of around 0.3% at this point in time. So really unchanged for the markets at this point. The Midcap index is up around 0.6%. So holding up very well for the Midcap index. The BSE small cap index should also come up for you. In terms of sectoral gainers, we have a couple of, we have the IT, the Nifty IT index, which is holding with a good gain of around 1%. The BSE cap goods index, which is up around 1% as well. On that note, we'll...
we just wait about. I think we may be getting some pictures of Rajnath Singh taking charge as the defense minister. So we'll while we await that, just keep an eye out on a couple of these other stocks as well. Ramco Cements, for instance, for the last couple of trading sessions, saw a bit of profit taking for a lot of these south-based cement companies, but now they've found some bottom as well. So they're moving off lows, currently moved to the high point of trade into the green for Ramco Cements. India Cements, the other one, though it is in F&O band, it has recovered from the lows, was in the red for most part of today's trading session so far, has now moved into green as well. And we have Dixon Tech. Yesterday we saw a big move coming in from Amber, and now Dixon too has done well, and we have Voltas, which has moved to the high point of trade.
Yes, absolutely. A lot of stocks, but one particular stock that I'm tracking is Biocon. So that particular stock should come up for you. Before that, that is Rajnath Singh. There are some visuals coming in of Rajnath Singh, in fact, taking charge as the defense minister. We'll keep getting you more updates on that, but those are some visuals which are coming in terms of the cabinet ministers in the past couple of days taking charge, and now we have visuals of Rajnath Singh taking charge as the defense minister. Okay, well, we'll keep getting you more visuals of that. As of now, the markets are quite stable and quite steady. And remember, it's been a huge run-up for the markets since those June 4th lows, simply because of the continuity, the stability that the markets really like with Modi 3.0. Welcome back. Well, there are some more visuals of Rajnath Singh, in fact, taking over his position as Defence Minister. So those are some visuals which are coming in on your screen at this point in time. Well, for the markets, it's holding very steady. So there's no real problem which is coming in terms of the market. Steady state for the Nifty as well as the Midcap index has been this entire week, with the markets really showing steady gains. As you can see, some more visuals coming in of Rajnath Singh.
I think it'll be very interesting to see whether he addresses the press also, just the way we've heard from other ministers, including the likes of Hardeep Singh Puri, etc. Largely because the street is betting not only on continuity anymore, they're looking at accelerated reform, etc., especially with the defense space, indigenization and upgradation of the defense equipment that we have. That would mean higher allocation towards defense spends. And at the same time, we've seen a big opportunity come by for all these defense stocks, which have seen a big rally already. So that is something that the street would be betting on. So we have some visuals coming in of Rajnath Singh once again taking charge as the Minister of Defense.
Yes, and I think he has indicated that, modernization would be one of the key themes that he would be looking to play out. And safeguarding India's border will also remain one of the top priorities for Rajnath Singh. So that will be important to watch out for in terms of his key priorities. I think that's on Rajnath Singh, and we'll keep getting you more updates from there. But as of now, let's focus on life insurance stocks, which have surged after the Insurance Regulator and Development Authority of India has introduced revised surrender value norms. Yash is here with the details on this. Yash.
Well, Ekta, as far as the revised surrender value norms from the regulator are concerned, they're certainly a big negative for life insurance companies, particularly for two life insurance companies, HDFC Life and Max Financial Services, because these two companies have the highest amount of exposure to the non-participating business, a business which is highly vulnerable to policy surrenders. If the move is that big a negative, then why are the stocks up? Essentially, the reason is that this takes away the uncertainty of what will happen on surrender value. Now, the insurance companies know that surrender value has been increased by the regulator. They know the levels to which it has been increased. And now the market will focus on what will be the strategy from these life insurance companies when it comes to mitigating or minimizing the impact which may come on the margins because of higher surrender value. Also, these companies were anyway trading on historical low valuations, plus it was being factored in as far as the price is concerned when it comes to higher surrender value. So all those reasons leading to this pop in insurance companies' prices today. But what is the move? Essentially, IRDAI has made regulations on increasing the special surrender value. Now, with the regulations and the formula suggested by the regulator, on a 10,000 rupee annual premium, if the policy is surrendered after the payment of first year premium, annual premium, then the insurance company will have to, pay back about 7,823 rupees to the policyholder as surrender value. Now, just look at this in the form of percentage. It's about 78% of the premium received by the life insurance company will have to be paid back to the policyholder in case a policy is surrendered. There has been a lot of back and forth on this one. December 2023, the first draft came out, which suggested 80% as surrender value. There was a lot of resistance from life insurance companies. After that resistance and representation, the surrender value was brought down to about 30%, but that was the guaranteed surrender value. After that, the regulator spoke about increasing the special surrender value, which eventually will take the total surrender value higher. Again, the regulator suggested taking it to 83%, and now the final regulations with a little bit of relaxation that has been given, the surrender value, special surrender value has been fixed at about 78%. As I said, a big negative, particularly for HDFC Life and Max Financial Services. But the good part out of this is that the uncertainty is now out of the way.
Uncertainty is out of the way, and that is something that the street is relieved by, Yash, going by the stock price moves. But let's talk about Biocon. It's informed CNBC-TV18 that they've received an adequacy letter for a generic drug. Ekta, what drug is this and what does this mean?
Well, yes, Biocon has told us that they have received the adequacy letter for Biocon's generic liraglutide API, which is basically a drug master file from the US FDA. What it means is that an adequacy letter is issued when the review finding of the particular API is adequate and is completed. It attests the quality of the API in suitably controlled tests. So that means that this particular liraglutide API, which they did file with the US FDA, has filed the required or gone through the required tests which are needed. Now, why is this important? Is because liraglutide is that GLP-1 drug. They already received approval for it by the EMA, the European Medicines Agency in the UK. It is Novo Nordisk's first generation GLP-1 medicine. Remember, GLP-1 medicine is basically the weight loss drugs which are making all of the waves world over. But it is a first generation drug. It's not semaglutide or the other ones which are introduced by Eli Lilly. It is the first generation liraglutide. But nonetheless, it is expected to be an important drug. The drug size is $500 million plus in the US. There is an expected generic entry in June 2024, which is anticipated. So that would be something that the street would probably watch out for. The impact also, according to analysts, is that it helps validate the company's scientific capability of developing complex GLP-1 drugs, because that's going to be the next big trigger for all pharmaceutical companies. How are they going to capitalize on the GLP-1 opportunity in the next couple of years? Now, Biocon, by doing this, just gives you an indication in terms of their prowess within that space. The UK liraglutide approval also was the first generic approval for this molecule in any advanced market. So that's the important part to note. It just gives evidence of the scientific capability of Biocon. Maybe they could be front runners just based on what you're seeing when it comes to liraglutide.
Take that point. Thank you, Ekta, for that. With that, we'll step into a short break. On the other side, we speak technicals. Aditya Agarwal, Head of Research and Investments at Invest for Edu, joins in with some trading strategies. $23,400 on the Nifty as we speak. The dip has been bought, but not bought to the extent that we go back to record highs that we hit earlier in the part of the morning. And the biggest reason for that is the Nifty Bank. So if you just take a look at both these indices, the Nifty is up around 1/3%. The Nifty Bank just about 60 points higher, or 0.1%. And that's exactly the concern that the street has been facing, because in the last 8 sessions, if you look at it, the Nifty Bank has gone ahead and crossed the 50,000 mark on an intraday basis 5 times, but closed above that only once, and that was on June 3rd, which was basically the day where we saw the big pop in the markets on account of the exit poll, and thereafter there was a big decline and then recovery. All those recoveries, every time the Nifty Bank has crossed that 50,000 mark, it hasn't closed above that. Nifty options expiry today, it's a Thursday, so we have the 22,400 call, which is extremely active. That's 23,400 call, I apologize, and that has a premium for almost 100 rupees. So just take that call off. The 23,400 call is extremely active, telling you 23,450 to 23,500 could be a bit of a resistance. At the lower level, we have the 23,300 put as well, which is equally active. So there's the 22,300 put, the 23,300 put equally active, telling you that the support in the market is closer to 23,250 or 23,300 itself. In terms of stocks, looking at fresh longs coming in on Oracle Financial Services for the second day running, the stock has been doing extremely well. A lot of shorting activity in the FMCG space. So we have Marico and Dabur, both of them in the red, seeing some short positions being added. Let's see whether there is follow through or not. And yesterday we spoke about how Z is likely to exit F&O ban. It so happened, but it seems like the street wants at least one media stock in the F&O ban, and that's what Sun TV Open Interest is indicating, that the stock may enter F&O ban today. So that's something we'll watch out for. On the options, 23,350 to 23,550 is the range that the street is playing for when it comes to expiry.
Okay, all right. Thanks, Manglam, for that. Aditya Agarwal now joins in to discuss the technicals of the market. Aditya, welcome to the show. Well, stable as she goes for the markets. What would your call be on the index as well as specific stocks?
Good afternoon, Ekta. Good afternoon, Mangalam. Thanks for having the show. It's a flat market, absolutely. Even though we are making new highs on the Nifty, we're not seeing a runaway rally, and I think so that is likely to continue, Ekta. On the upside, as Mangalam pointed out, the option data is also suggesting a resistance around 23,450, 23,500. I think markets will face resistance around those areas, and you could see again buying around 23,300, 23,200. So between this 250, 300 point range, I think market will continue to oscillate for this week, maybe for next week as well. And maybe once this time-wise correction and consolidation is done, then maybe we can have a next leg of rally towards 23,600 or 24,000. Case in point being, banking index is something which is underperforming. So that has to start outperforming from here on, and the banking stocks have to chip in for the overall market to start inching towards that 24,000 mark. And 50,000, as Mangalam also pointed out, is clearly acting as a major hurdle for the Bank Nifty. Between 50,000 to 50,200 is what I'm eyeing. Once Bank Nifty sustains above that, that will give a clear indication that the Bank Nifty is also poised towards 50,500 to about 50,900 on the upside. Overall, there is more stock-specific and sector-specific activity which we are seeing for the past couple of trading sessions, and I think that is likely to continue going ahead as well.
All right, and individual stocks, what would you recommend?
So I've got a couple of buy recommendations, Mangalam. The first on my radar is UPL. Now this stock, after a decent correction, has finally started to inch higher and is trading above its 200 DMA after 1.5 years now. And a good consolidation has led to a breakout in today's trading session. So on the upside, one can play the stock for a target of 580 to about 600 with a stop loss at 544 on the downside. The second stock recommendation is Muthoot Finance. This again has broken out into an all-time high territory. Now I think from here on, stock has further upside. Can test levels of 1900 with a stop loss at 1750 on the downside. I will be a buyer in the stock.
Okay, just a quick question. Wanted to understand if you are looking at Sanofi, that stock is doing well today. 52-week highs over 10,500 odd rupees. It's currently at around 6,500 odd rupees. Is that a stock which is looking good technically? What would your approach be?
Yes, Ekta. So it has broken out from that range, and I think so. One can definitely look at the stock. This is a long consolidation from which it had broken out last week as well. So I think this is likely to continue, and you can see levels of 7,500 about 8,000 on the upside, with a good support on the downside 6,000. In fact, a lot of these stocks within the pharma space, the names like Abbott, Zydus, all of them are looking very interesting, and Sanofi also is one of them which actually stands out within the entire pack.
All right, thank you for joining in, Aditya, and giving us your view on the markets and individual stocks. What we'll do is take a short break, come back, focus on the primary market space. Pranav Haldia, who's the MD at Prime Database, joins in as the IPO season is back with more than 24 companies expected to go public over just the next 2 months. Stay tuned.
Welcome back. Well, IPO season is back, or rather is continuing, with more than 24 companies chasing around 30,000 crores, which is expected to go public over the next few months itself. To discuss this and more, we have Pranav Haldia, who's the MD of Prime Database, joining in. Pranav, hi. Thank you very much for taking the time out. Well, you know, now that we have the elections out of the way, we have a verdict which the markets are quite happy and sanguine with, and you know there is stability in terms of the markets. What is your sense when it comes to the IPO pipeline for the remaining part of the fiscal? You know, it was up around 19% in terms of IPO fundraising in FY24. If you had to put some numbers, what are you expecting in FY25?
Well, so first of all, thank you for having me. This time elections were actually a non-event for the primary market. If you look at historical data of the 4 previous, election cycles of 2004, 2009, 2014, and 2019, you had a total of 28 IPOs raising about 7,500 crores cumulatively across those 4 election cycles. In this year, in the 6 months leading up to the elections and the 2 months of the elections, you had 52 IPOs raising 50,000 crores. Like you said, IPO season is continuing. It's not back. In fact, April and May of election years has typically been an extremely dry period. But again, this year you saw 7 IPOs being launched, raising close to 15,000 crores. So this year, this election season has been a bit of an anomaly. Of course, there's been a bit of volatility in the recent past. And as we've seen that primary markets generally do not like any kind of volatility. But I think, the kind of run-up that you've seen recently bodes extremely well for the pipeline. As we said right now, there are 18 companies which already have SEBI approval, which are looking to raise close to 20,000 crores. Of course, Ola Electric, we all read about a couple of days back. Allied Blenders is another one. At the same time, you have about 37 companies looking to raise 50,000 crores, which are filed with SEBI and are awaiting approval. Some of the larger ones, of course, Afcons Infra, Bajaj Housing Finance, Valley Energies. So I think the pipeline looks extremely strong as long as secondary market continues to be buoyant the way it is. And at least at this point in time, it doesn't. There seems to be no reason why it shouldn't, especially with the kind of flows that you're seeing from domestic investors, institutional and retail. I think you should have a stellar year for IPOs in 24-25.
Take that point. The SIPs every month have become 20,000 per month for 2 months in a row. So if that trend continues, there's 2,40,000 crore rupees waiting to get into the markets. Obviously, not all can go into secondary markets. Some part of that has to find its way through primary offerings as well. I just wanted your thoughts on how much higher can this year be in terms of raising of funds as compared to last year, because that was a record year, over 60,000 crores raised.
Well, of course, you had previous years as well. 17-18 was another stellar year which had gone back. It's very hard to put a number really, but I think we should safely be able to cross last year's figures. One important aspect is also that unlike last year, wherein you had a lot of IPOs, but relatively smaller deals, the average issue size was only about 800 crores last year. I think what already you've seen in the last couple of months and some of the issues which are in the pipeline as well, you will see some larger deals hitting the market as well. Of course, we haven't spoken about it, but the mega issue of Hyundai is eagerly anticipated, which is expected to be the largest IPO, even beyond what LIC had raised. Okay. So, I think we should comfortably be able to cross previous highs as far as IPO fundraising is concerned.
Okay. If you could just dissect it sector-wise for us, Pranav, because last year there was not that much participation from the BFSI space. Are there more IPOs lined up from that space as well as these new age companies where the presence was quite limited?
Well, of course, as far as new age is concerned, you have Swiggy, which could potentially be listing for this year. As you rightly said, last year you did not see BFSI segment in a major way. In previous years, you've seen 60 to 70% of the total funds being raised actually from the BFSI sector, which actually is not a huge negative as far as I'm concerned. You saw issues from a whole wide variety of sectors. Manufacturing sector also came in a big way. And I think that bodes extremely well, for the overall capital market ecosystem when you're seeing a large number of companies across sectors, across sizes, having the confidence to tap the primary market.
Right. I just wanted your understanding of the trends over the last few. Hang in there. Actually, as we speak, we have visuals of Ram Mohan Reddy taking charge as the minister for Ram Mohan Naidu, rather. Taking charge as the Minister for Civil Aviation, the youngest minister in the cabinet, all of 36 years.
Just 36 years old.
TDP, and is taking charge. So that's pretty cool. In fact, we had heard from him. One of our colleagues had done an interview with him about a couple of days ago as well, and he said his focus was to make air travel a lot more accessible, because earlier what was actually something that was a mode of travel for the rich is now becoming a lot more broad-based, a lot more affordable, and that is something that he will continue to do. So maybe make air travel a lot more accessible with the number of airports that are announced and a lot of the things that we'll be tracking here.
Yes, absolutely. And he's a youth leader, 36 years old. Yeah. His mindset towards aviation might, in fact, be different from what we've seen. So that'll be interesting to note. But nonetheless, his plans are to also address those high ticket prices, prioritize Andhra Pradesh projects, as well as focus on the common man's issues. So these are some points to note in terms of his tenure as the aviation minister. And obviously what stands out is that he was born in 1987. So He's definitely younger
Youngest
than
minister,
me.
high flying, literally out there. And I hope he makes flying a lot more comfortable, a lot more affordable, and a lot more accessible, along with us going to a lot of other places in the country which are not connected by air as well. But let's go back to our conversation on IPOs. I just wanted your understanding on the funds, the sellers side. I mean, earlier you would have a lot of the money that was raised by companies in terms of a fresh issue. Then you had a lot of promoters offering their shares as OFS. Now you have a lot of the private equity investors, offering their shares to the public market. So how has that trend changed? The quantum raised via fresh issue versus the quantum which is secondary sale?
Well, so again, last year, which is 23-24, was a bit of an anomaly, wherein you saw 47% of the total amount being raised, was actually fresh capital. In comparison to previous years, where this used to be about 15 to 20%. So last 5-6 years, you've seen the OFS component being 80-85% of the total amount actually being raised. So last year was a bit of an anomaly. At the same time, this entire debate of stay away from issue, if there are private equity investors selling out, I don't buy into that argument. I think it's a sign of a maturing capital market ecosystem. We have to realize that these investors are the ones who are identifying these companies at the early stage, putting in the risk capital at that point in time. And of course, they need to provide an exit to their investors as well. If we go back to the 90s or even early 2000s, a lot of these companies were actually coming to the primary market for this risk capital. And which is why you saw so many companies, either completely shutting shop. You also had a few vanishing companies. But what you're now finding is that companies which are hitting the market are far more evolved, far more mature in their life cycle. They've had multiple rounds of fundraising, multiple rounds of due diligence, and I think that gives a lot of comfort, especially to retail investors, for some of these issues.
Okay, all right, Pranav. We're going to leave it on that note. Thanks very much for joining in and giving us all of your insights in terms of what we can expect in the overall fundraising and primary market action going into the rest of the fiscal. Well, we need to take a short break, but on the other side, we'll get you more on the markets. A lot of stocks lined up in terms of trade today. More on that in just a bit. Welcome back. Just watch out for Torrent. That stock is down around 1% in what is a relatively good market, and that is because their Indrad facility was inspected by the US FDA. It was a pre-approval as well as a good manufacturing practice inspection, which took place from the 3rd to the 12th of June. The company was issued 5 observations in that particular inspection, and none of it was related to data integrity. But remember, this particular plant already has a warning letter issued in 2019 and already has an official action indicated status issued to it in Jan of 2023. So I think the street will watch out for what the status of this particular facility is post the inspection. On that note, we will take a short break. On the other side, Manisha Gupta will join in. She has with her Atul Chaturvedi of Sri Renuka Sugars. Stay tuned.
Welcome back once again. That excursion towards that 23,400 mark for the Nifty was sold into, but thereafter the Nifty has shown resilience back again at 23,400. We'll keep an eye out on that. At the bottom of your screen, you have Orient Pro, which is up around 5% as one of its arms gets the RBI not to operate as an online payment aggregator. What it means in terms of business opportunity for them and, the size is something that we will try and ascertain, but until that happens, the stock is up 5%. The street likes the direction in which this news has gone. Even as the market is holding up around 23,400, a couple of these stocks are doing a lot better. So from a stock which was recently excluded from the Nifty, UPL has seen a recovery of almost 2.5% from the lows. So it's a vertical up move that we're seeing out there, up at the high point with a gain of about 2% We're seeing the India VIX decline as well, and a stock which was a recent inclusion into the Nifty, Shriram Finance too, is doing well. It's sitting with a gain of about 3%. So we are seeing some traction, even as HDFC Life and all these life insurance companies continue to see some gains, and that's on the back of relief coming in on clarity from the IRDAI. But I do believe we have with us Manisha in the studio. Manisha, all things commodities.
All things sugar, by the way. I mean, the way the sugar prices have been in the international markets and the way the sugar stocks have been surging, it does tell you that perhaps some policy and reform is in the markets, is in the works. And that's exactly, or something that the street is actually anticipating. We are then joined by Atul Chaturvedi's Executive Chairman, Sri Renuka Sugars. Mr. Chaturvedi, hi, thank you so much for joining us. First of all, on MSP, because that is what the street believes can be the first reform that we can see from the government. The expectations are quite on the higher side. What are you hearing and what is your sense? Because in the last 4 years, we've seen FRP being continued to be hiked, but not the MSP.
No, in fact, the industry has been asking for a revision of MSP or minimum selling price, essentially to make this as a kind of an institutionalize the whole process, because FRP keeps getting increased and the minimum selling price doesn't move. So if this is increased, then it will send the right signal, and it will also give the signal to the farmers that their money is going to be assured in future, as the industry is not going to lose money. So I think this message, hopefully the government will probably revise this. So we are quite.
Mr. Chaturvedi, what is your sense on what is the industry asking for? Because the current minimum selling price is 31 rupees a kg.
In fact, if you really, the industry has been looking at something like 41 rupees as the price. So we just have to see whether, and this is all ex-factory, whether this happens or it doesn't happen. We still are watchful. But I think some action is definitely looking to be on the cards.
All right. Mr. Chaturvedi, one, of course, is the sugar minimum selling price. The other is very bullish statements coming in from the Ministry of Petroleum and Gas, where they have talked about the blending on track, 15% already done in the month of May, and on track for 20% blending. That sends a very bullish signal for overall sugar as a sector. What are your numbers, and would you also say that 20% is on cards now by the end of next year?
In fact, this announcement by the Honorable Petroleum Minister has actually come as a whiff of fresh air. In fact, in December, when the cane juice ethanol and B-heavy ethanol was banned for making ethanol, so we were all very disappointed, and the headwinds were pretty high because sugar production was going up and it was adding on to our interest burden. But now this statement reaffirms that the government has not put the plan on the back burner, and the government is committed to ensure that the Prime Minister's target of achieving 20% blending by 2025 gets achieved. And I'm sure the kind of thrust which the new minister is giving and the kind of signals the new minister is giving definitely augurs well, not only for the sugar sector, but for maize as well. And if we look at the numbers this year they were expecting 825 crore liters to get 15% blending. As of 31st of May, almost something like 327 crore liters has been supplied. And the big change is that grain ethanol is now competing strongly with sugar, and it's a kind of 50-50 ratio. So I think all this is good signals, and it should be helpful to the sugar industry to cut down on their interest burden.
So while both of these things are quite bullish and in works perhaps, and that's exactly where the sugar stocks seem to be reacting with, do you think that this would be a part of the first 100 days, the sugar minimum support price, and of course, long-term pricing policy for ethanol?
So what is more important and at this point of time is that the industry has been asking the government to increase the price of ethanol which was supplied to the OMCs till now. So that needs correction. And as the FRP for the new season has already been announced, increase in FRP. So it is imperative that this is also done for next season. So what the industry is anticipating is that the price of cane juice ethanol should be more or less in tune with what the government is giving for maize-based ethanol, which is about closer to about 72 rupees, which means an increase of about 7 rupees from the current price. And similarly, the B-heavy ethanol price also needs to be jacked up in the same proportion, which would mean that it will now become something like 65, 66 rupees or thereabouts. That's the industry's requirement and demand. Let us see how things pan out as we go forward. And I'm sure some action is likely to be taken.
right.
Yeah.
That may spell decent news for the space, and we're seeing decent traction in all of these sugar stocks as well. Thanks a lot, Mr. Chaturvedi, for joining in, and Manisha for taking us through that conversation. We'll wrap up on this note from Halftime Report, but stay tuned because Business Lunch will take all the market action ahead.